Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. Warren Buffett once said, "We haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have." And so we begin. Today is Tuesday, August 6th, 2024. Whoops. In today's episode, we start with talking about the bounce from the explosion. Not recovered? What next? Ever since the yield curve inversion over 2 years ago, people have been asking, what's going to be the spark that sets off the market, that sets off the explosion? We saw a spark, we saw an explosion. The VIX, as I stated yesterday, has not seen as high as it was yesterday since 2020, and before then, the great financial crisis. And before then, I don't even know, I don't have the chart before 1990, but since 1990, it's only hit that level, well, 3 times now. Again, 2008, 2020, and yesterday. Now, you might be looking at markets going up today and saying, oh, well, that might be it. That might be the time to buy the dip. And you might be right. I do have a crystal ball, but you know what I mean. One thing I just want to add to the thinking process about this in general is the way that I kind of look at the market and, sparks and explosions. I mean, think of how the great financial crisis started. Really, it was the Lehman Brothers bank blowing up, right? And then explosion after explosion, the housing market blowing up, everything blowing up all over the place. And so the way that I look at it is that we did have a spark, we did have an explosion, and now we're trying to see if things are still on fire and if things are going to continue to explode. Now, the problem is that I don't see the fireman coming, I don't see the Fed coming, I don't see anybody coming to the rescue, and I don't expect them to. I think that we're in a fire, and I'm expecting more explosions. The way I see it again is like a warehouse full of like canisters of gas, and ever since the yield curve inverted, one of the canisters has been leaking lots and lots of gas. It caught fire, one of the tanks exploded. That was, you might say that the first tank that exploded was the Japanese yen carry trade. Seeing as what had happened with the Japanese market, which actually recovered today from yesterday, that was sort of the explosion. Now we still have fire. The VIX is still highly elevated. It went way down today, but it's still very elevated, and we'll go through a lot of the charts. I'll go through the charts as when we get there. But one other thing I want to add to this, Gareth Soloway on his show, Great Soothsayer, that I talk about a lot on this show because I watch his show while I'm looking at my charts every day. He's got 25 years of trading experience. He does know what he's talking about. His comment was he's waiting for SMCI. It's a microchip / Bitcoin holding producing company. They had their earnings come out, and he was waiting to see if it was really good or bad. The reasoning is that there's so much market cap weight right now in artificial intelligence, and not really artificial intelligence, it's the semi-chips. Those companies have enormous weight in the S&P 500 and the NASDAQ, and they are enormously overpriced. They're priced to have their earnings like explode forever, like go way up. And so if we don't see that with SMCI, the idea is that is damaging to the idea that earnings can continue to be really strong in semiconductors moving forward, and that could really continue. That could be the next canister that blows up. It's the AI bubble, they might call it. As of the recording of this video, actually, it looks like they just released about 5 minutes ago their earnings, and they did not come out good. So by what Gareth Soloway says, he's expecting another huge move down across all indices tomorrow. As you can see clearly from Yahoo Finance, Supermicro Computer, in after hours is down 8%. That's a very large move down. That's going to take a lot of confidence away from people that think that semiconductor companies are going to make infinite amounts of money moving into the future. This is the slowdown of earnings that Graham talks specifically about in The Intelligent Investor. It's amazing how you can have this age-old advice just playing out right in front of your eyes. But anyway, another big news event that I haven't seen anyone else talking about, but the 3-year, 5-year is now flattening. Let's take a look at it. So looking at the U.S. Treasury yield curve, I've been talking about this end, 1 month Treasuries all the way through, 3-year Treasuries have been above, the longer dated Treasuries. Now they're not supposed to be, because you're supposed to be able to get more money for letting someone borrow your money for a longer period of time. But when the Fed raises rates and to the point where the yield curve is inverted, then you have it all backwards. Now, eventually, as people expect more and more cuts on the front end of the curve, the Fed funds futures rate, you'll start to see these dots one by one drop lower than the further out dates. And we recently had the 3-year clearly above the 5-year, and just today we now have the 3-year at 3.76% and the 5-year at 3.73%, almost completely flat, very, very close to uninverting here, with the 3-year obviously dropping below the 5-year. This is another canister waiting to explode. Just to reiterate, like I've talked about many times before, the recession usually is like very clear. It's more official that we're in the recession when you get those GDP numbers shrinking, and that always coincides with basically after uninversion. And so we've been inverted for so long, and now we are uninverting, and it's going that way. And so so this is it. Let's get through the rest of my intro chart here. This Thursday in 2 days, we do have initial jobless claims coming out, and it could be another barrel waiting to explode. It's expected to have 9,000 less initial jobless claims, which would actually mean that more people are getting jobs. That they're expecting more people to, or rather less people to be filing for initial jobless claims. And so we'll see if that happens or not. It'll be interesting. If you've been watching my show, you probably know what I'm going to say. I'm expecting jobless claims to go up here. Period. Next Tuesday, Wednesday is the next real data that's coming out, with CPI and PPI being a major inflation gauge. Daily reminders, 2-year, 10-year yield curve is still past its second birthday. Never happened before in history, means that we are probably headed into a pretty bad recession or depression, and the Somme rule has now been triggered to add to the fire. And from that metric, you can pretty reliably state that the recession has started. Moving on through the charts, this is a daily of the S&P 500. It felt like a pretty, if you're invested in stocks, you probably are pretty happy today. It went up by 1%, but the way that I see it is that the explosion stopped exploding, and now we're kind of waiting for the next thing to explode. And because there's a fire, there's an elevated chance of more explosions. That's the way I would visualize that. I personally cannot imagine this as being a bottom here, but you know what, anything can happen. But for now, it looks like we're still on the bear train. Adding to, that case, the VIX futures curve is still obviously very elevated. The front end of the curve is way above the whole rest of the curve right now, suggesting that volatility it's not over. The game is not over. Another way to look at this is the daily chart of the VIX, the VIX, the pricings of options contracts. Again, When this goes up, it means that the premiums on contracts that are further away in price for their strike prices is going up. You have to pay more to get options contracts because more volatility is expected. And if, as far as chart patterns go, if you're a chartist, you will be able to recognize this as what is called an inside day. And so by this metric, you can actually, I would actually, believe it or not, expect another leg up in the VIX. I know it's hard to believe, seeing as though yesterday's VIX pop went higher than, it's only, like I said, we've only seen that 2 other times in history since 1990, 2008, and 2020. I know I keep repeating it, but it's immensely important to realize that. This is an inside day, which means traders likely are buying the VIX here and expecting it to continue higher. TLT, I obviously suffered a bit of loss today. As you might know, I have leverage on Treasury bonds, and we went down today. Could this be a blow off top? Could we be headed back to this line? Maybe. Could this, be a bounce where we were just continuing higher here? I don't know. I'm very, very curious about this, obviously, but I can't see very clearly exactly where we're going to be going from here. But one thing I can say is that the 30-year Treasury yield, this is the upside down version of TLT. When this goes down, TLT basically goes up in a nutshell. And as you can see, pattern wise, this doesn't look like we're gonna go straight back up, does it? It looks more like a bounce that's more likely to head lower, or at least maybe retest this trend line maybe before heading back down. I'm not really sure what the course is here, but yeah, again, very curious about it. I mentioned yesterday I have puts on HYG with a strike price at 77.50. We're now I'm out of the money by about 4 cents. Doesn't expire. My contracts, I think, expire. I think this Friday. I have to check. It's not a huge position. It was just like, why not get in on the action? But obviously that those puts lost a lot of value today. I do expect this to be going back down, especially, but what can really add to that is Gareth's experience and belief that this one company, SMCI, will be kind of the next spark of the next leg down. So that gives me hope for my own bearish positions not to be. Anyway, I wanted to bring up pyinvesting.com Fear and Greed Index. This is a trading method that basically determines, it tries to avoid volatility. And right now it's actually, believe it or not, still 100% invested in stocks and 0% cash, even though it detects fear. I find that interesting. I thought that fear meant this thing would flip over here. So it's a decent way of being able to avoid volatility. It works really best when there's like a slower bear market. I don't think it does as well with crashes. Obviously, if this is a crash, it's still sitting in 100% stocks right now, but I like to keep my eye on it to see more of like a bigger sense of where the big picture is headed, like month over month. Are we going down the next month and the next month, and for however long? This doesn't see that much fear yet. Meanwhile, on a shorter time horizon, including their own, fact that this says fear right here, the CNN Fear and Greed Index is securely still in extreme fear mode today. That did not change. The fire is still burning, I guess we can say. I do want to, might as well just show this version of it. The CME Fed Watch tool, we're still expecting, I was wondering with today's bounce if the Fed funds futures would then okay, maybe it'll just be one cut now because the market's actually okay. No, that didn't happen today. So the cracks haven't been resolved. The market's still on fire here, pretty clearly, from all ways of looking at it. IWM, I mentioned yesterday how we cracked through this trend line, and we almost revisited it today, and so this could be the retest. Maybe we turn over here. And triple Qs also, I just wanted to show up some of the main indices here, just as to the way this looks. This does not look very bullish at all, does it? Actually, now that I draw that there, what is this? This looks a little bit like a head and shoulders. I don't know. But any way you look at it, I expect it to keep going down from here. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching. Robschild.